How you guys doing? Another financial video. You guys put more content out for financial stuff, which is really important to me. That's my pretty much day job. What I have a passion for and getting alpha and stuff like that. So here at Century City, just watched Beetlejuice. I really enjoyed it. I really liked it. Strongly recommend you watching it. It's really cool. Michael Keaton, he's the best. So today I'm recording this on September 15th. Financial markets have done pretty well this past week. The Nasdaq went up 6% this past week. It was on a tear. S&P is up as well. I believe Dow Jones is up for the week. VIX went down. Volatility risk, fear index, I guess. Bitcoin fear index has gone down a little bit. I think as this trading this about 58,900. Another thing, guys, a little disclaimer: this is not financial advice, guys. This is my own thoughts, my own opinions. I own my own financial firm. Just speak with a financial consultant or myself. Click the link below if you want to schedule an appointment, or go to jungagency.com for that. But it's really important that this information that I'm throwing out there, which I want to freely share, but this is for informational purposes. This coming week is a huge week. Jerome Powell will cut interest rates this coming week. We still know 25 basis points or 50 basis points. That's the biggest question. And what kind of rhetoric he's going to say. He has a dual mandate where keeping inflation low. Inflation has come down. Let's keep an unemployment rate, subsiding that rate, not it going up, which kind of spooked the market last time. A lot of still things going on with the carry trade still right now as the yen starts to appreciate. It has been appreciating. I think the high was at 160, but now I think it's at 142, I believe, as I'm recording this. Let me see 1 second here. It is 140 right now, so it's pretty strong. So as that appreciates, Wall Street banks are going to have to unwind their trades in the U.S. in order to cover and pay back your loans that you borrowed in yen. So converting dollars to yen and pay that back. And so that can get some volatility. I don't think that's really over yet, to be honest with you. But it's all about the rhetoric, what Jerome Powell says in his notes. It's not just about 25 or 50. I think he'll probably do 25, maybe 50. But the economy seems like it's doing okay. I'm here in Los Angeles. I live in LA. Actually, Culver City, but obviously LA, Culver City, Santa Monica, same thing pretty much for most people. But I think that coming in, as they start printing money, the markets are about monetary money supply. And as they increase that, did you know the fact that from 2000 to 2024, the dollar is debased over 25%. Your purchasing power has gone down 25%. Do you know the debasement of the dollar last 4 years has been 25%? So it's really important to get into the markets. I think personally, non-investment advice. But then again, you're scared. I have a lot of clients calling me. They're scared. They want to get in the market. They know they have to. Real estate will probably appreciate, stocks, everything, you name it. That's what happens when they print money into the markets. The money supply, I think it's at the greatest it's ever been. And when you print money, things just go up, unfortunately. That's kind of the bad thing about printing money. Assets go up. It makes it tough for all Americans in terms of, especially the middle class, and to deal with all the inflation that we're dealing with. So that is kind of started by the Federal Reserve and all the banks central banks across the country, as they stimulate the economies to prop them up. So that's why you have to be investments. That being said, be careful because there are stock market crashes. I think that we're going to be prone to one. I'm not sure when. It's like I'm living in LA. They always talk about this major earthquake's going to happen. We don't know when it's going to happen. It will happen, obviously. This past week had an earthquake, but we don't know when the big one's going to come, but it's going to come. I feel the same thing about market crashes. I've been doing this since 1998. I've been in the markets. So I've seen 2000, 2007. I've seen 2022. That was kind of a recovery. But generally, when the market crashes, it takes about 6 to 7 years to recover. And then when you recover, you've probably lost about 25% purchasing power, probably, I would imagine. So you're in a really bad place. Another thing, no knock on mutual fund managers or managers. When the market's down, you're still paying. If you're in a mutual fund, you're still paying 2.81%. You might have that 401k that you're laying at your old job at Fidelity or some other company in Power, doing a lot of rollovers, and you're still paying a lot of fees. It's not about just the fees, the trading costs. You can do the research on that. I'm continuing to talk about this 2.81 fees in terms of management fees for mutual fund, the average. And index funds, obviously, which I strongly recommend, which are great. That being said, you're still subject to market-utility losses, and that's kind of the thing that I'm always stressing on. So that's pretty much take on that. Again, my name is Stephen Jeung. I work with products that are principal protection. What I learned back in my days at Merrill Lynch is what I've learned is you want to preserve your wealth. That's the number one. You never want to deal with a market crash or a huge correction. So that's why I like indexed annuities. I know insurance companies are at war with Wall Street. Wall Street always demonizes indexed annuities, how bad they are, how bad the product is, but that is all FUD. because the new indexed annuities are awesome. I have family, friends are in them. I love them. I recommend them. They have upside of the market with no caps. Goldman Sachs. You have General. You have a lot of great BNP, a lot of great indexes with no caps. The S&P ones have caps because they're popular, but I don't put people in products with caps. A lot of these indexes with the participation have outperformed the S&P 500 for the last 20 years. If you can believe that, which only 10% of mutual fund managers, money managers can do is outperform the S&P 500. I'm with that. And then IULs too. People talk about IULs. Why are you doing IULs? Dollar for dollar, you're better off doing a Roth IRA, tax free if you can qualify. Majority of my clients cannot qualify for IRA. They're doing backdoors and stuff like that, but you can roll over those into a index annuity. But IULs are great. I like them. The fact that you can pick the right index. They have a lot of great a lot of different features that 401k doesn't have. 401k is great. Don't get me wrong. They're getting free money, match, go dollar for dollar up to the match. Everything above and beyond that, I would do it. A traditional IRA or an IUL, because IUL has tax-free withdrawals. All the withdrawals you have, because Section 7702, you're able to take your cash value that grows into the policy. You're able to pull out tax-free loans, like what the wealthy have been doing for many, many years. And do that in 401k. You have to wait till 60, which is annoying. So you have no liquidity until you're 60. Number two, as living benefits as well. A lot of people I speak with, I consult with, if they cannot work and provide wages for the family, they're in financial destruction. So it's really important to make sure that you have living benefits in the event that you have a heart attack or a stroke or you become in a nursing home. The IUL actually activates the policy prematurely, so you can actually get paid out on that, which is huge. And then number three, there's obviously a death benefit. It's irrevocable, which is not. It's revocable, which is nice. You can change the beneficiaries. You can put in your estate. It's a dynasty trust. That's what the Rockefellers did. That's why they preserved their wealth for 3 generations, opposed to the Vanderbilts, which squander all their money after, I think, 3 generations or 2 generations. I'm not too sure. 2 or 3. Another thing is that uninterrupted compounding interest. People don't understand what that is. It's like owning Tesla stock, like Elon Musk. The reason why Elon Musk is so rich is because he held onto the stock, never sold his shares, borrowed his money from Wall Street firms like JP Morgan and Bank of America, and held onto his shares. Security-based line of credit, that's what he got, Vernon Scott, and that's why he's the wealthiest person in the world, because he didn't sell his shares like majority CEOs do. Because Tesla's not the most valuable company by far. And same thing you can do in IUL, you bargain your policy, you still have the upside of the market. Kind of like a margin loan against your stock, you still participate in the market. You have a margin loan, but you don't have to pay it back if you don't want to. But interest is occurring, obviously. Right now, as I'm recording this, it's like 5%, but the index that I'm working with right now is doing about 14.97 for the last 20 years. It's the best high. It's an institutional actually index. The only institutional firms, insurance companies can get into. And then just what else I love about it? Under compounding interest, living benefits, death benefit. Oh, no market loss. So the market crashes 20-30%. You're not affected by that. Your cash value is based upon indirectly into the index. So therefore, if the index does well, then you get credited. If it doesn't do well, you don't get anything for that year. So that's what I like to as well. So a lot of people out there just invest in the market. Like people I speak to they're not very risky people. But when you're into a variable account, when I used to work at Wall Street, at Merrill Lynch, and all those firms, the only thing you can really promise people is that stay in the market. But there was a lost decade when I was advisor from 2000 to 2009, 2010. The market did zero. Could you imagine making zero money in the stock market? A lot of you guys are too young to remember that. Another thing, get an advisor that's been doing this for 20, 30 years, that knows crashes, knows how to respond, who's seen. Markets do not repeat what they rhyme. So anyhow, guys, I hope you like this information. I want a bit more content out there for you guys, just my knowledge I want to share, and what I've learned working with the wealthy, working in Silicon Valley and Merrill Lynch. So now I have my own firm, Jeung Agency, and I love it. Been around since 2011, 5-star on Google. And I'm at this point in my career, I'm about helping the common folks. Because wealthy people know all these tricks. They know how to manipulate the tax code. Not manipulate, they just know the tax code. A lot of people who are teachers, lawyers, most people just don't know that. So I'm here to help as a resource. JungAgency.com if you want to learn more. Description below, link in the bio, whatever. Anyhow, that's my thoughts. I do think that the market is going to go up for sure with these markets cuts. And one thing that I like for my short-term stuff is IWM. I think small caps are going to rally and outperform NASDAQ or S&P 500. It's like 20 basis points for management fees. So that's what I'm doing personally for my short-term money. IUL, index annuities and stuff like that. It's more long-term, 10-year period of time. It's not a short-term thing. So, and now, guys, do me a huge favor. Like this video, share this video, and I'll see you on the next one. Peace.